Two people retired the same year, same salary, same retirement date, same amount saved. One paid $74,000 in taxes and the other paid $31,000. That $43,000 difference was not a mistake. It was not a bad investment. It was the income that stacked in the year of retirement, and whether anyone had modeled it before it happened or only after. Here's what most people don't realize. The year you retire is not the year your income drops. For most people at the $2 to $5 million level, it is the highest income year of their adult life. Partial salary from the months you worked, severance taxed as ordinary income at your marginal rate, deferred compensation that pays out on separation from service, and equity that vests or that you exercise before you leave. All of it is taxable, all of it lands in the same calendar year. None of it in the retirement plan most people built, because most retirement plans start the year after you leave and skip the year you actually retire. The person who paid $74,000 didn't follow a plan. The one who paid $31,000 modeled the retirement year specifically, before it happened. If you've not modeled the tax picture for the year you actually retire, this video is specifically for you. I'm Ryan Knoll, founder of Nav Wealth, where we help our clients pay less tax in retirement. Today I'm going to show you what exactly creates the income spike in the retirement year, the 2 mistakes that make it worse, and the 3 moves that bring the tax bill down before December 31st of that year. And at the end of the video, I'll model out exactly what this should look like for someone in your situation. Most retirement plans model income starting the year after you leave. Year 1 of retirement, with no salary, portfolio withdrawals begin, Social Security timing decision is made. The math works, the bracket is manageable. What most plans skip entirely is the year of retirement, the year the salary stops partway through and everything else arrives at once. Here's what actually shows up on a W-2 and 1099 in the year most people at this asset level retiree. First is partial salary. If you retire in June, you've earned 6 months of salary. For someone earning $300,000, that's $150,000 of W-2 income, before anything else is counted. The tax withholding on that salary was calibrated for a full year. By the time you leave in June, you're already looking at the 32 or 35% bracket for the year once you add in additional items. Next is severance. Severance is ordinary income. It is taxed at your marginal rate in the year you receive it. A $100,000 severance package paid in the year of retirement stacks directly on top of the partial salary. Most people negotiate severance without modeling its tax cost, because that conversation happens month before the retirement tax picture is clear. Then you have deferred compensation payout, and deferred comp elections made years earlier often trigger on separation from service. The payout date, the installment structure, and the tax year it lands in were all elected years ago, often without knowing what other income would be present in the same year. A $200,000 deferred comp payout in the retirement year can push the total tax bill by $50,000 to $75,000 beyond what the plan assumed. And then there's equity vesting and exercise. RSUs that vest in retirement year are ordinary income at that vest date. Options exercised before leaving are ordinary income at exercise for non-qualified stock options, or AMT income potentially for incentive stock options. Equity compensation in the retirement year can be the largest single income item, and the one least likely to be modeled in the retirement plan. And there is one more that most people forget entirely: the bonus paid in January for the work done through December of the year prior. If you retire in March and your prior year bonus arrives in February, that income lands in the same tax year as your partial salary, your severance, and your potential equity awards. It was earned last year, it is taxed this year, in the year you were planning to retire into a lower bracket. If you stack partial salary, severance, deferred comp, equity, and prior year bonuses in the same calendar year, and the retirement year tax bill routinely reaches $60,000 to $90,000 for someone at this asset level, often $30,000 to $50,000 higher than any year while they were working. Most people know intellectually that the retirement year will be complex. What they underestimate is how many separate income streams arrive simultaneously, each one logical on its own, all of them catastrophic on the same tax return. The income spike is unavoidable to some degree. The mistakes that compound it are not. Mistake number 1 is starting Roth conversions in the retirement year. The Roth conversion corridor is valuable, but it does not begin in the year you retire. It begins the year after, when earned income is stopped and the taxable income picture is finally clean. Starting conversions in the retirement year on top of partial salary, severance, and equity income converts money at the 32, 35, or 37% bracket when the same conversion done 1 year later would cost 22 or 24%. I've seen this happen repeatedly. Someone retires in July, has a good tax advisor, and they know conversions are important, and they convert something like $100,000 in October of that same year. At their marginal rate in the retirement year, that conversion costs $35,000 to $37,000 in federal taxes. Done in January of the following year, that same conversion costs only $22,000 to $24,000. The eagerness to start the strategy cost them $13,000 in a single transaction. If you are going to do conversions the year you retire, I typically do them for my clients in December. I'm able to add up all of their income sources to make sure they have room. And if we find out they do have room, we convert just enough to not tip into high brackets unnecessarily. Now for the second mistake, which is not adjusting withholding or making estimated payments. When salary stops mid-year, the withholding stops with it. Severance and equity compensation may have their own withholding, but often at a supplemental rate of 22%, which is significantly below the marginal rate for someone in the 35% bracket. The result is a large underpayment that arrives as a tax bill in April, plus penalties for underpayment throughout the year. Here's why this matters beyond the dollar amount. The withholding system was calibrated for a full year of salary. When salary stops in June, the IRS still expects quarterly estimated payments to cover the income that kept arriving. Severance in July, equity vesting in September, deferred comp in October. Most people don't know how to make those payments because nobody told them the withholding gap existed. The first indication is the April bill. A $74,000 tax bill in April is not just expensive. It arrives when a new retiree has no salary income and is drawing on the portfolio for the first time. The timing compounds the financial stress and forces a portfolio withdrawal that was not planned for, often from the wrong account, at the wrong tax rate, in a year that was already the most expensive tax year of the retirement. For our clients retiring this year, we map the quarterly estimates against the actual income calendar. Severance in July, equity in September, deferred comp in October, and we make the payments in the quarter the income hits. By April, there's no surprise bill and no underpayment penalty because the cash was already with the IRS in the right amount at the right time. If your retirement is within 5 years and nobody has modeled the year you actually leave and beyond, I built a tool that helps you know if you're ready. Not just the year you retire, but for the next 30 years after. The link is in the description. And if your numbers are not what you expected, there's a second link to book a call with my team. We'll model the full picture and build the plan that brings it down. Now, there are 3 specific moves that reduce the retirement year tax bill. All of them require action before December 31st of the year you retire. Move number 1, model the full income picture before you retire, not after. Salary through the last day of work, severance amount and payment date, deferred comp payout schedule, equity vesting dates and exercise decisions, unused vacation payout, and total that number. Compare it to the tax bracket thresholds. That projection, done before you retire, determines every other decision in this list. And then you move on to the second move, which is to delay Roth conversions to January of the following year. Unless there's a specific reason a conversion must happen in the retirement year, and there rarely is, you want to wait. The bracket in year 2 of retirement is almost always lower than the bracket in the retirement year. The same conversion costs less. The strategy is not delayed by waiting 1 calendar year. The cost is reduced by $10,000 to $15,000 per $100,000 converted. And then move number 3, make sure you make estimated tax payments in the retirement year to avoid underpayment penalties. If withholding will fall short because salary stops mid-year and the supplemental withholding on the severance and equity doesn't cover the gap, make quarterly estimated payments to fill the difference. The penalty for underpayment is not enormous, but a large April tax bill in the first year of retirement is a financial and psychological hit that is entirely avoidable with a single calculation done in September of the retirement year. The retirement year is the 1 year in the entire financial life where the income picture is the most complex and the tax planning is most commonly skipped. The people who plan for it pay $31,000. The people who don't pay $74,000. Same income, different outcome. Let's jump to a case study about Mark and Linda. Mark retired a few years ago from his plumbing job, and Linda's a $300,000 salary executive retiring June 30th. Here's what her retirement year stack looks like. $150,000 of partial salary, $200,000 of severance, $400,000 of deferred comp lump sum on separation, $250,000 of RSUs vesting in quarter 1 before she leaves, plus a $75,000 bonus paid in February for the prior year's work. That's a total of $1,075,000 of W-2 and 1099 income in a year they expected to be transitional. Without planning, their federal tax bill is approximately $310,000. Her withholding while she was working covers about $190,000 of it. April underpayment is about $120,000 plus penalties. This forces a portfolio withdrawal of $130,000 from the brokerage account sold at long-term capital gains rates, adding another $15,000 to $20,000 to the tax bill, and they're looking at $340,000 to $350,000 in federal taxes for their retirement year. With planning executed by August of the year before retirement, the severance timing could have been negotiated to be split across 2 years, deferring $100,000 on income to the following year, and the deferred comp election could have been restructured to a 2-year payout, reducing income by $200,000. RSUs come due as planned, and she receives her salary while working. Without those two income pieces, their gross income drops to $775,000, and withholding drops along with it to $124,000 for the year. They will owe roughly $190,000 in federal taxes on that income, and are roughly $66,000 short once you factor in the withholdings. They will pay that as an estimated payment from their portfolio to avoid IRS penalties and interest to the IRS. Next year, they will need to navigate potential Roth conversions on Linda's $2 million 401k and Mark's $1 million IRA around her deferred income and severance pay. They will need to hold off another year, but depending on what the future RMDs look like, it may make sense to go ahead and convert anyways. Then beyond next year, the Roth conversion window is wide open for even more tax savings. The year you retire is not the year your taxes get easier. For most people at this asset level, it is the year they get harder, because more income sources arrive simultaneously than at any other point in your financial life. And the plan most people built starts the year after. If you're approaching your retirement date and you haven't modeled the income picture for the year you actually leave, that conversation is worth having right now, not in April of the retirement year when the decisions have already been made. There's a link in the description to get on our calendar with your specific numbers and your specific timeline, and an answer just for you. Because the smartest thing you can do with your retirement is make sure every decision counts. I'll see you in the next video.